What do you expect today?
I think I saw on CNBC yesterday there was a survey, and the result was unanimous. 100% said the Fed isn't going to do anything, and I have nothing to add to that because that seems absolutely positively correct. The Fed is going to keep rates unchanged and probably have a message that they are kind of encouraging inflation to go higher. One of the most important statements that I think has gotten less play than it should is Jay Powell said in late October. He said that we would have to see a significant rise in inflation that is persistent to even consider raising interest rates to fight inflation. So the Fed wants inflation to be higher, actually, and they've contextualized this by saying, well, 2% was our target for many, many years, and we fell short. So now we need to kind of fill the gap, which makes no sense to me whatsoever. I think it's a cover for wanting interest rates to basically be below the inflation rate, which seems to be the game plan for central banks in developed countries really around the world. And so now we have the 10-year Treasury yield is below the inflation rate. The CPI is up at 2%. The core CPI is up higher than 2%. And yet the interest rates are being kept below that. So Fed knows that we have a debt problem in the United States and that the way to push it out, the day of reckoning out into the future, is to have interest rates below the inflation rate, which has been accomplished now by the Fed.
I want to talk to you about Jay Powell. You said the other day that you'd give him a C- if you were grading him, and you likened him to a losing NFL football coach. How's that fair?
Well, because Jay Powell 12 months ago had a framework about what his outlook was for 2019, a basic framework about viewing the world. And that framework was quantitative tightening on autopilot, regardless of economic data, and successive interest rate increases during 2019. And 3 weeks later, it was exactly the opposite. So it's difficult to give him a lot of credibility in the messaging because of the U-turn that was taken. And instead of raising rates successively in 2019, we've cut rates 3 times in 2019. So a very different playing field for 2019 than what we expected. I think the one reason that I'd give Jay Powell a C- and not a D is that he has said, and I'm not sure we can believe him because we couldn't believe what he said last December, he has said that to fight the next recession, he does not believe negative interest rates are a good idea in the United States. And I applaud that as loudly as I possibly can, because I think negative interest rates in the United States would really be a problem for the global financial system. He has said he will do large-scale asset purchases to fight the next recession, which means, obviously, a quantitative easing program. So what we are looking at is an environment where the next recession, I believe, left alone to market forces, long-term interest rates would probably rise. But Jay Powell, I believe, has told us, if we can believe him, because he changed his mind so quickly after his December statements, but he's told us that he will control long-term interest rates to fight the next recession through quantitative easing.
What's wrong if he simply realized, and the Fed realized, that maybe they made a mistake by raising rates last December?
Nothing's wrong with realizing they made a mistake.
And the playing field, using your language, changed, perhaps. The trade war, there are tariffs. Actually, he's had to manage his way through all of that.
Yes, I suppose. You're being kind of generous. I mean, when he did the quantitative tightening autopilot statement and the successive interest rate increases, the risk asset markets were already having trouble. It wasn't like that suddenly him saying that led to the decline of over 20% in the stock market and the closure of the junk bond market, where there were 2 months where you couldn't even float a new issue junk bond in the fourth quarter of 2018 because the market was closed. This was all because of what the Fed was doing. And yet it was when the market finally flushed out down in late December where the apology tour came out. So I think that what happened was the Fed thought they had a framework that was working. The markets threw a temper tantrum about it, and they were forced then to go back to basically the Fed model that we've had for quite a few years now, which is following the market rather than, I mean, the great Paul Volcker just passed away this week at age 92. He was the one that really had control over what the interest rates were and wasn't just listening to the market. And I wish that if the Federal Reserve has a purpose, it should be to have an outlook and follow it regardless of what the market does. And instead, Jay Powell capitulated and went along with what the bond market has said. And now The bond market's completely in sync with the Fed. I mean, you have Fed funds rates, the same basically as the 2-year Treasury, which is kind of the same as the 5-year Treasury, which means that the Fed is now comfortably on hold. But what Jay Powell has done is he raised rates 4 times in 2018, then cut rates 3 times in 2019. We basically have gone nowhere. We've just put ourselves on kind of a wild ride, which I believe was unnecessary.
Are you against the concept and the idea of an insurance policy? Because that's what it was. It was taking out an insurance policy unless things got bad because of the trade war and other issues, be it geopolitical or otherwise. You can throw Brexit into that stew and the uncertainty of knowing where all of that was going to play out. What's wrong with an insurance policy?
Why did you raise rates 4 times in the first place is my reaction to that. There's nothing wrong with adjusting policy, and you can call it insurance policy, you can call it a mid-cycle adjustment if you want to. But it doesn't seem to me that there's much chance of the Fed really following through on this mid-cycle adjustment concept, because that would mean that we're going to raise rates again. Yet Jay Powell in October said to raise rates, we need a substantial increase in inflation that is persistent. So even if inflation goes up, what they're telling you is there's no intention of raising interest rates unless the dynamics change pretty remarkably. So all we did was raise rates 4 times just to cut them 3 times. We should have just left them alone the whole time, is my opinion.
Do you think he should be replaced? I mean, he's taken fire all year long from the president.
No, I don't think he's any different than what you would replace him with. I think the Federal Reserve has turned into a body that's essentially following the market. And now the bond market is saying there's no purpose in raising rates. So they're not going to raise rates. There's no purpose in cutting rates. And so we're probably going to be on hold for quite some time. The bond market says that will probably be unchanged interest rates until maybe the 3rd quarter of next year. And that to me is what's motivating the Fed.
Labor market's pretty strong. The economy's pretty good. Stock market's at record high. Well, yeah. Some would look at that and say, you know what, the Fed has somehow managed to do its job pretty well.
Well, some people give credit to the president, too. But you're on the labor market. What's interesting is people keep talking about how great the labor market is, and it's good for sure. But the job growth under Trump for 3 years is less than the job growth of the last 3 years of Obama by about 10%. It's about 10% less. So that's not any better. What's better is people aren't getting laid off. That's what's better about the labor market. Weekly unemployment claims are really low. They're at about 200,000 right now, which is the lowest tick in a long, long time. They're down by about 30% from the last 3 years of Obama. So in the last 3 years of Obama, job growth, payroll growth was pretty good, but people were getting laid off to the tune of about 300,000 per week. Now it's down to the low 200,000. So that's a pretty big drop. So that, I think, is why the economy is perceived to be better on the jobs market, because the labor force participation has increased. It was under a steep decline for many, many years. And starting in about 2016, in the last year of Obama, it finally started to improve. And I think that's the good thing that's going on in the economy.